Hi, good evening everyone. It's really a pleasure to welcome all of you physically present at Motilal Oswal Towers to the 27th Wealth Creation Study. I also would like to welcome all the people who've joined us live on the YouTube stream today. This report is indeed a very unique report, and it gives you a very good looking back as well as looking forward perspective. This is presented every year by our co-founder, Mr. Raamdeo Agrawal. This report essentially is split into two parts. The first part is the statistical part, which covers the fastest, the biggest, and the most consistent wealth creators over the last 5 years. It gives you a peek into the history of wealth creation, and it looks at it from the lens of market capitalization. And this is based on data over the last 5 years. The second part of the report, which is actually the most interesting part of the report, and this is the part that most market participants, investors, a lot of our clients and distributors look forward to, which is the thematic part. And over the last 27 years, I mean, there are a lot of themes around investing that the wealth creation study has covered. And when I look back, and I'm naming this report because the report which is going to be presented this year has a connect with that report. There was one report which spoke about classifying companies into good, great, and gruesome, right? Basically, that report said you can classify companies into three components: good companies, great companies, and gruesome companies. Now, this year's report, the theme part of this year's report, looks at a very different and unique way of classifying companies. It classifies companies into two components: consistents and volatiles. Essentially, what this report says is there is a unique lens of looking at all companies. I mean, not just in India, but across the world. There are only two types of companies: consistents and volatile. So this is a very different lens, and I don't want to talk too much about it because we have our co-founder, Mr. Raamdeo Agrawal. He's a stalwart in equity markets. He's been in investing for the last 3.5 decades. And he's the force behind the research, the philosophy, and the investing prowess of Motilal Oswal. So without any further ado, let me call him on stage to present to all of you the 27th Wealth Creation Study. Raamdeo ji, over to you.
Good evening, friends. Let me again welcome all of you to Motilal Oswal Tower physically after two years. I think we didn't present for 2 years physically, and again we are back in the game of presenting it physically. So all of you are welcome here, and more particularly the people who are on YouTube all over the country. They're also welcome. In fact, they might get to see and hear far more clearly than out here. But so everybody's welcome. This time the study, every time for me, wealth creation study is a step up in my own learning. That's how it goes. And this time, though we have taken a help of one of the book which inspired us, that is Howard Marks' book of Mastering the Market Cycle. That was an initiator, but we didn't get much of fabric of what we have done in the study. So this is very ground up and original thinking from our side, and there could be some caveats in terms of what statements we are making. Investing is not simple. Investing cannot be reduced to 2x2 metrics. It's an art form, and these are a few tricks which you use while investing. So a flick shot is a very powerful tool for a batsman, but that is not total batting. I mean, for batting you need many more tricks to tackle the fast ball, your googly and all. And I think cricket would have 4-5 types of bowlers, but stock market has, I think, unlimited number of bowlers and unlimited speed at which it comes. Wickets are different. So I think investing is very interesting, and And hence, this is one framework which has taught me something which I was doing, probably I was doing wrong, that I will talk about it a little later. So there are two dimensions of wealth creation, that is consistents and volatiles. So typically what happens is that all the companies, they look to be same, but underlying when you look at it and you see the data when we'll present, that there are consistents, the companies which make profit very consistently in a predictable fashion, and there are companies which make large profits, but they are not predictable at all. So they are volatiles. So when we went to find a definition for volatiles, I mean, there are so many companies which are volatiles, and we said first we have to find the definition of consistent, and then what is not consistent is volatile. That's how we have gone about it. So we'll talk a little more about it as the presentation progresses. So this evening the wealth creation study has two parts. First, the data part of it. In last 5 years, what has happened in the market, which are the biggest wealth creators, fastest wealth creators, and those kind of things. And second is the thematic, your consistents and volatiles. So let's see what kind of wealth has been created between 17 and 22. So concept of wealth creation is the process by which a company enhances value of money given to it by the shareholders. So the entrepreneur or the management of the company is a magician, and he creates money out of literally nothing. I mean, if you look at the companies like Liver, Nestle, all the companies, Infosys, TCS, they literally have spent nothing to build this 50 billion, 100 billion, $200 billion empires, and they keep doling out cash and dividends and everything. So these machines are created by the managements. So that's the magic. Globally it happens, and in a much more big, mega scale. In India also we have global companies and of course the local companies. Then net wealth created. Change in the market cap over the period. What is the between 17 and 22, whatever money has been created, market cap has been created, we have reduced the amount of money company by chance has raised, that we have reduced to the net wealth created for share buybacks and dilutions. So this 5 years, the net wealth created is 92 lakh crores. By this top 100 companies, 92 lakh crores of wealth has been created. This is by far the largest wealth creation in a 5-year period, between 17 to 22. We have been seeing from in 2001 to 6, it was 14 lakh crores. Then it became 16, 17, about 20s and 30s. And then it was more like 70. Last year it was 70, and now this has climbed to 92. I'm sure this number will keep climbing as the size of the market grows and pace of the wealth creation increases. And hopefully we are going to see more than 100, 200, 300. Today, market cap is about 280 lakh crores. I'm quite sure in next, say maybe in 10 years' time or 12 years' time, you'll see in one 5-year period, 290 or 300 lakh crores being created in the marketplace. That's the power of this market, and it is a very consistent market. We'll talk about it as we go forward. Then the pace of wealth created. I mean, not only that size of wealth created is largest, this pace of wealth created is also fastest. It is at about 28% compounded, whereas the market has done at about 15%. So almost all the wealth creators, they have outperformed the benchmark by 10 to 15%. So even you look at it, Reliance has done it at the rate of 32% compounded, TCS has done it 25% compounded. We'll see that data. So it's not, don't focus too much on the market. Right now, the talk about the market is so much. What's going to happen in the market? Where the market is headed? At what pace market is going to grow? Everybody is focused in the market. Nobody is focused on the stock. Very few guys are focused on the stock. So this is the time in country like India, which is very consistent. I think you've got to be focused a lot more on the stocks than the markets. So which are the biggest wealth creators? Hold your breath. Reliance Industries at 13 lakh crores in just 5 years period, 13 lakh crores has been amassed by Reliance at the rate of 32% compounded. And the P multiple, which was 14 in 17, has become 30 in 22. So the company has grown at about 32% compounded. The earnings have grown about 14-15%. If you look at TCS, has created about 9.5 lakh crores of market, and it has grown at 25%. These are very large companies, but the pace at which they are creating wealth. HDFC Bank, another 4 lakh crores. Infosys, another 5.5 lakh crores. Bajaj Finance. So Bajaj Finance has grown at about 44% compounded. So all these, they need to be called out. ICICI Bank, Adani Transmission, Hindustan Unilever, Bharti Airtel. After 10 years or 12 years, first time Bharti is making an entry into the big list. And Wipro. So these companies, they have on an average created wealth at the rate of about 27% compounded in the last 5 years. And they are literally 50% of all the wealth created. So 92 lakh crores has been the total wealth created by top 100 companies. Of that, 49 lakh crores, so that's about 55-60% of that has been created by these top 10 companies. So pace and the size of wealth creation is becoming kind of a K-shape. You know, the top companies are creating bulk of the wealth in the last 5 years. The fastest wealth creating companies, the top 2 Adani companies have been top of the charts. Adani Transmission and Adani Enterprises, and below that, you have Tanla Solutions and other companies are also there. But this particular category had always been, kind of little notorious in the sense that the companies, if you're lucky to have any of these companies in your portfolio, they are more of a lucky strike than by design you can have these fast companies in your portfolio. And any one of them in your portfolio of 3-4% also, I think you don't have to worry about the future. You can retire with that particular inclusion. But you got to be smart and lucky to have these companies in your portfolio. And literally to appear in this list, the companies have to double at the rate of, literally it has to double every year. Another thing is that the 7 out of these 10 companies, they were literally, they were very small in 2017. They're about 3,000 crores or lower. So to find real multi-bagger, like everybody asked me, give me 1 or 2 multi-baggers. I said, if I have any multi-baggers in my hand, knowing that this is going to happen, then of course I would be God. So of course, nobody knows which is going to be the multi-bagger. Hence, one has to be careful. One has to be careful about trying to find these companies. And don't hesitate to buy into small and mid-cap companies which are ignored by the market or not known to the market about the story. Typically, these stories are undiscovered stories and completely unknown to the market. And that's where the ignorance and apathy towards these companies, that leads to when the companies do well, the stocks do well like unbelievable. Then you have the most consistent sector where we are saying of the companies which have done well, every single year, 5 years out of 5 years, the companies which have beaten the stock market indices, because you can beat in 5 years back-ended, front-ended, but every single year to beat the market is not going to be easy. So Adani Enterprises has literally doubled every year in last 5 years, but the earnings have degrown by 4%. So it's all because of re-rating. The company has done well. Then you have Alkyl Amines, Coforge, Mindtree, LLT Infotech, SRF, DVs, all fantastic companies which have grown their earnings at the rate of 25 to 35%. And of course, there has been again re-rating. I think re-rating has been a common phenomenon across the successful companies here. So not only you have grown at 10, 15, 20% their earnings, but anywhere between 5 to 10% compounded the re-rating has happened. And that has been the source of what you call mega size wealth creation. Maybe probably the re-rating has happened because of the low interest rates. Till about 2 years back, the interest rates were zero. So it fell from 3-4% to zero, and that led to equity boom all over the world. And we saw all kind of irrational activities in the loss-making companies, startups. People, last year digital companies went through the roof because discounting rate came down significantly, and that led to a lot of even good companies being discounted. Instead of 50 times, they got discounted at 80 times, 90 times, 100 times. That's the only academic explanation I can see. But what else has happened in the market? Is it the supply? Is it the manipulation? I don't know. But I think one running theme is that the re-rating has happened in last 5 years, which is completely unprecedented. And all-round wealth creators, the companies which are biggest, fastest, and consistent, all three ranks we have added up, and then we said total of the ranks, the lowest one are the ones which are the most all-round wealth creators, I would say. And Adani takes the cake this time between number 1 and number 2. They are the ones, and then after that you see L&T and L&T Infotech and Mindtree, Divi's Lab, SRF, Bajaj Finance, Reliance Industry. I mean, to come here, Reliance Industry, that's some achievement. So, because typically, I mean, very large companies don't make it here. So, this company, because it has done at the rate of, I mean, it is by far number 1 in terms of biggest, but even speed is not that bad. It is more like a 44th rank. So that has brought it here, and so a lot of things which were not expected has happened in the marketplace in last 5 years. Now we looked at the, just get some water. By industry, which are the industries which went big in last 5 years? So technology, IT, has been the biggest wealth creator. Out of 92 lakh crores, 25 lakh crores has come from IT. And this industry has been consistently creating wealth in last 25 years. Last 22 years, there is no year when the industry profit has degrown. So it was the industry was about 1% of the total profits in 2001. Today it is 14% of the total profit. So this is what is happened in last 22 years. So this is one of the sectors which is backbone of the Indian industry's march in the stock market. And you have a fabulous companies like TCS, Infosys, SCL Tech, Wipro, and now L&T Mindtree is also shaping up as the 4th or 5th largest company. So Tech Mahindra. So these are very large, extremely well-run corporations. Then you have the banking and finance, which were in doldrums in last, say just before COVID. I think COVID was the last, what you call, shock to this sector, and cleaned up, but still it is the second largest. And then you have consumer and retail and oil and gas. So these are the 4 very large segments. Oil and gas is nothing but Reliance. So Reliance is a sector in itself. And but I see that telecom and realty, these are 2 sectors which are coming out of despair. You know, and this particular thing, when it is coming out of despair, has the potential to make a significantly larger amount of money in the years to come. I mean, it is just when I'm looking at data, it is looking like very predictable kind of a scenario for next 5-10 years, because I have seen telecom is a very consistent industry. The demand is day to day, it's very essential. It is just that fighting in the competition among the 2-3 players that brought down this industry to literally a wealth destroyer. So we'll talk about it a little more, but it looks telecom in reality in next 5-10 years could be very interesting segment, though it's small right now, but it could add a lot of wealth in the years to come. Public sector, it used to be about 35-40% of wealth creation was by, and look at number of companies which were participating till 2005. 25-30 companies used to be the wealth creators. Today, 1 company has participated with literally 0 wealth created. This is data till March 22. In 6 months, a lot of things have happened. PSU banks are flying. Many other defense stocks are also doing well. So maybe, I mean, this is the worst of PSUs, and quite possible as we go forward, at least better days could be there. I mean, it cannot be worse than this. Zero number of companies, 0 wealth creation. So I think the ultimate contrarian buy or a trade, I would say, this is a complete despair, discarded valuation, and companies are not. I mean, so this shows the apathy towards the companies run by government. I think government is also, what do you call, they're trying to get out of this. So maybe a wiser counsel will prevail, and they will try to be a little less hostile to their own companies, and maybe I think better days are ahead. But very stark, from 49-50% to literally 0. So that is the first part of the study. So let's look at the theme of the report, Consistents and Volatiles, two dimensions of wealth creation. So there are two types of companies. I mean, very simply put, the companies which in a predictable way, they, year after year, they keep making money, and larger amount of money are the companies, we call it consistents, and the companies which are not consistent are volatiles. And let me tell you, 80%, 85% of the companies, if there are 4,000 companies, 85% of the companies are volatiles. And so I personally used to think that, in fact, our logo is also buy right, sit tight, and QGLP, and that is silently applicable to consistent companies. That I was not aware. I could feel the difference between a consistent company, a secular company, then a cyclical and volatile companies, commodity companies. But I was not able to think very clearly what are the rules of investing in a consistent company and what are the rules for investing in volatile companies. We'll talk about it, but that is the biggest learning what we have, because you can differ how I define the consistent companies. You can have your own definition, but you can't take away the core of the thought process that the companies which have predictable earnings has to be seen very differently, and the companies which don't have predictable earnings, jo dikhta hai wo bikta hai. So if you don't have predictable earnings, your market is not going to give valuation, or it is going to be extremely volatile for the wealth creation. So the whole process started with reading of the book called Mastering the Market Cycle, and it's quite a book. I would suggest that everybody should read, and extremely well written. And he had come to India also. We had listened to him, but initially when I met him and when I heard him, I thought this is not for me. I am not this type. And then as the time passes, you realize that what you think is not relevant, it is definitely relevant to you. And that's where we thought that let's do the study, because when you study, you go deeper into that. So what he's saying is that we cannot know where the cycle is headed. Everything is cyclical in life. We cannot know where the cycle is headed, but we can surely know where we stand in the cycle. Are we at the top of the cycle or are we at the bottom cycle? That at least we can know and decide our strategy based on that. Second thing he says, if you can't predict, actually nobody can predict the future very clearly. If you can't predict the future, you should know the past deeply. We can know the past very deeply, and that is where the differentiator comes. When you pick the stocks, we don't do enough research about the past, 10, 15, 20, 30, 40 years. Now with the digital database, what is not available? Everything, every corporate action, what has happened to the financials, what has happened to capital allocation, how they're disposed of, how they're dividended, everything is there. We got to know, and you will know a lot by reading the past, because that is what is going to decide the future. And maybe while reading the past, you might get some semblance of the future also. We tried to apply the idea of cycles in Indian companies, and there we found that the cycle word is not right. I think because you got all kinds of things. 1 year it goes up, second year goes down big time, it goes to... So we found it very volatile. If you ask me, if the company is not consistent, they're all volatiles. They could be cyclical also, but the companies are not predictable. That is what is a better word. So we called it consistent and volatiles. And these are two sets of companies. So the way we have defined, because for lack of, visually we can do individual companies, but we said we want to run a data set. So how exactly we define the consistent companies? So here, consistents we define over a 15-year period. We said 2007 is a good period for 15 years, because 10 years will be short. Let's look at 15 years. So 15 years, all the companies which are listed in 2007, we took all those companies and we said, let's bring a little significance. So we said any company which is more than 100 crores market cap, we will study all of them for next 15 years. So that's how we arrived at about 697 companies, and no other filter, just the little significant companies, more than 100 crores since 2007, and those 700 companies have been the part of this study. And the annual profit after tax should not fall by over 10%. We said some company, after growing for 4-5 years, if it comes down by 5-10%, we should not call it inconsistent. So we said, let's give a band of 10% for calling it consistent. Then we realized that because of COVID and various other things, in corporate history, always something or other happens where the drop of the profit is more than 50%, but basically the companies are consistent. So we said for every 5 years, we'll give one drop of more than 10%, but not more than 50%. Because the company can have a 100% drop and then again journey start. So we said in 15-year period, PAT should not fall by more than 10% for the more than 3 times and 2 times in 10 years. And no fall in PAT of greater than 50%. Any company like Bajaj Finance fell by, I think, 65% in COVID period. We called it volatile. But basically the company is consistent. But just to maintain the purity of the study, so that's what I'm saying. When you look at a company, you can decide for yourself what changes, what adjustment to make. And we said terminal year should be higher than the starting year, so that you don't get a company which is completely junk. None of the companies were junk when we did the study, but still, as a caveat, we just put it. So all companies are not consistent, are volatiles. So here is let me explain you. So HDFC Bank turned out to be the only, these are examples of consistents and volatiles. Various types of it. So HDFC Bank, if you see, it's a perfectly consistent company or a bank. From 2008 to 22, every single year, 40%, 41, 34, 33, 31, 31, 27, 22, 20, 19. It looks like magic. It looks like it is unreal. But this is what is the number which the managements have delivered in last 25 years. 15 years, and even you go to 25 years, the numbers are same. Actually, the initial year numbers are even bigger. So that is the epitome of, I would say, consistency. Now second, SBI, very credible bank, 22-23% of entire banking market share. 41%, 22, 7, and then minus 7. 40, 17, minus 21. 20 plus, minus 28, minus 100. And then it got into loss. And then from loss to profit, and then the recovery is very rapid. And now it is making record-breaking profits. But it is very volatile. Very volatile. So this is volatile. There is a largest bank which is volatile, and second largest bank, HDFC Bank, is absolutely consistent. So from one industry, same opportunity, you can produce 2 different kind of results. And markets clearly value it in a very different way. Very, very different way. So Ultratech, it is a very kind of a commodity type of industry. Only one company which is kind of a consistent. If you look at it, there are 2 years when it is broken down by 19%, 11%. So since it crosses 10%, we call them, it is absolutely bordering the limit, but still because of that 3 drops, it is consistent. Sri Cement, on the other hand, has done very well otherwise. But look at the reporting, 68% drop, 11%, 47% drop. And again, next year it comes back. So these are the companies which, for some reason or other, have decided to report the way they have reported. Cummins, to my surprise, it's a capital goods company, has just broken by 12 and 13%. Then you have ABB, which is kind of a little more volatile, with 82% drop in 2011. I don't know this number, but this is how the companies have been. Reliance, again, epitome of consistency, just 2 drops in 15 years of 2% and 5%, which is within 10%. So this is also super consistent. I would say after HDFC Bank, if there is anything consistent of the size, it is Reliance. And in the same sector, we have tried to bucket it within the same sectors. And then you have the BPCL. Look at what is happening there. It's all over. Minus 51, minus 53, minus 14, minus 40, minus 13. I don't know what will it be for 23. So that inconsistent leads to unpredictability of what will be the profits in the years to come. And that distorts the mind of the investor and the markets. So we put together some 15, 17 kind of characteristics of both of them, consistents and volatiles. So typical nature of the business is secular in consistent and volatile is cyclical. Industry leadership, almost guaranteed. 85 out of 114 companies where industry is number 1 or number 2 in their respective field. That is Absolutely. I mean, most of the leaders are, because of their consistency, they go to the leadership position. So mostly leaders, and so all the consistent companies are leaders, but all the leaders are not consistent. Just listen to this. And volatiles, because they are not getting the leadership, they are more like a follower or smaller companies. Then you have the pricing power. I think the biggest source of what you call consistency is the ultimate pricing power of the companies. And the other side, the volatiles, they might be doing big business, big profit, but they may not have the pricing power. Competitive landscape, very favorable and unfavorable here. We'll get to the examples later on. Business strategy, very strong value proposition, and the weak value proposition in the same industries I'm talking about. Excellence in execution. This is the core thing. In India, opportunities are galore in every field. The managements which can execute are the managements which are going to win. Then we are talking about influence of government regulations. I think that is the biggest thing. Wherever governments are regulating a lot, they are putting for every damn thing you are going to the government, those industries are, they are not able to grow, or they are not able to show consistent performance. Like look at HPPP, IOC and those kind of stuff. Then we are talking about future earnings, relatively more predictable, and here it is unpredictable. Average return on equity very high and relatively low. Debt equity low, relatively high. Dividend payout higher and lower. Valuation approach, earnings based. Because you can predict the earnings, P multiple should be used only in those companies where earnings are predictable. Because DCF works, cash flow works, you can do any discounting, dividend discounting, earnings discounting, free cash flow discounting, operating cash flow, because those things are predictable. The companies where it is not predictable, you have to find some other way, and that is the asset-based valuation, capacity-based valuation. So fundamentally, you have to change the way you look at the companies, and markets are very smart. It's not that market doesn't know, it's that we don't know. We have to change ourselves rather than market. Market is very smart. Market is at the top of the profit cycle in commodity companies, they give you 3, 4, 5 P multiple. And we wonder why the P multiple is so low when the index is at 22 P multiple. It is because of this, because they are unpredictable. And market valuations typically premium to the benchmark. We are not able to understand why these consistent companies are 2x, 3x, 4x to the market, whereas a lot of these commodity companies or volatile companies are at significant discount to the indices. And valuation range very narrow. These companies, they are not only expensive, but they move in a very narrow range. Whereas the volatile companies, they move in a very wide range. And compounding, the consistents are very strong compounders, whereas these are very weak compounders. And percentage of Nifty market cap, hold your breath, 72% of the market cap of Nifty are consistents. Only 28% are volatiles. So sources of consistency and volatility. So industry level factors and company specific factors. So look at it, nature of demand. The fundamental thing is, if the nature of demand is consistent, you are going to get consistent possibility of a company. It is not a guarantee that in a consistent demand, consistent industry not necessarily produces consistent companies. There are many more things, but first thing is top line. If you have a consistent top line, you have a chance to produce a consistent company. So look at Indian software exports. From $4 billion in 2000, it has consistently grown at 12, 18%, 19% to become 176 billion this year, and current year it expected to cross 200 billion in a very predictable fashion. And everybody is saying, look at all the studies, they are saying that we are going to hit 350, 400 billion in next 5-6 years. That is the core of TCS, Infosys, Wipro, because they have, in this kind of opportunity, they have the prowess to execute. And incidentally, even TCS PAT has grown at 18%. And if the nature of demand is volatile, like truck demand is very volatile, companies, the best of the companies can do nothing about it. So look at Ashok Leyland, which is a well-run company. I mean, telcos, even the automotive division is also extremely well-run. But you can do nothing if the demand falls by 30-40%. So that gives that is a source of volatility. Second, competitive landscape. This is one thing which is silently plays in the backdrop, but favorable competitive landscape will favor consistence and vice versa. When all the forces, bargaining power of suppliers, buyers, new entrants, threats from the alternatives, and the competition, I think most important of that is right at the center. If the players within the industry, they fight like cats and dogs, nothing can hold that the industry's fortunes. So in paints, in housing finance, and various other industries, there are multiple players, and yet they create a lot of wealth. But in telecom, there are only 2 or 3 players, and yet it's the ultimate wealth destroyer. So that is the difference of what the competitive landscape can do. So cigarettes, it's almost monopolistic or duopoly, and that's why 5 out of 5 goes to, and that's how you produce an ITC or VST or those kind of things. Then you have look at aviation. Everything is haywire. Whether price of fuel, whether number of entrants, government regulation, I mean everything, and the competition. I mean one flight goes empty, and they slash the rate so much that other guys also bleeds. So clearly this industry, at least so far, in India and world over, aviation is the part of life of everybody, and yet there is no company. Every 5 years, the whole set of existing airlines, except for 1 or 2, everything goes bankrupt, and you get a new set of companies. So that is cigarettes, they are same companies for last 50 years. Aviations, every 10 years you have a new set of companies. Value migration, this has been another very powerful force. The industries which are value migrating, those industries produce a very consistent business opportunity and hence consistent companies. Like IT services, we talked about it, pharmaceutical from India to rest of the world, banking from state-owned to private sector, telecom from fixed line to wireless, gems and jewelry from organized to organized, and aviation from full service to discount. So you see only Indigo has been some kind of a stability, but even that is kind of lost a lot of money in this COVID time. But still, I think from full service to discount is the way to go in India. Government regulation, I mean, we have seen what has happened to the oil companies and many other companies in that sector. They wobble when they get benefit also and they suffer also, but it brings volatility. Market doesn't like even positive volatility, because when the positive time comes, they don't get the valuation because they keep waiting for the negative times to come. So that has been the government has been one of the big interventions. It has been reducing, but wherever it is there, I think that is making a lot of difference. Then company-specific factor. So you got to have clear strategy and execution. You got to have clear goal. The companies which have clear goal, where they are headed, what they want to do, their focus, not diversified, and very sound strategy, very clear path to the goal. And then of course, 1% is strategy and 99% is execution. The guys who have that good execution, they have good team, good people, and good leadership. I think those are the companies, when you meet them, you can feel it. You know, like Astral, Balkrishna Industries, Page Industries, Aisha Motor, they come in all the, I can tell you stories after stories, and this is an opportunity to, really identify the companies which have a very clear strategy and execution. This execution prowess is almost a must for any company to become large, consistent companies. Though it is very difficult to explain in numerical terms, but they reflect in the high ROC, better cash flow, better turnaround of the assets. Everything is visible, and from there we go and ask the companies what it takes. What is that magic formula for these companies? Industry leadership. The sustained consistency leads to leadership in the industry. So what we have seen, all the leaders are not consistent, but all the consistents are leaders. So leadership is one of the very important trait, because as you become leader, you have the bargaining power with the supplier, with the customers, and even the smaller companies, they find it difficult to fight with you pan-India basis. So UltraTech is the great example of a very high number of companies in the industry, and yet because of their sheer leadership, they have been able to create a consistent financial environment. Pricing power, again, it's all correlated to the leadership and good competitive landscape. You end up finally getting pricing power. This is the final thing which actually helps the companies make. Ultimately companies are nothing but they are the agent of customers. They buy on behalf of the customers and they sell on to the customers, because all the costs are belonging to the customers. They only look at the margin. So the companies which have the capability to pass on all the costs and drive their margin are the companies like Hindustan Lever and all. They deal in commodities, they sell the brands. So that's where the pricing power comes, and this is one of the biggest things for creating the companies consistency in the companies. Polyplex, catering to the same FMCG segment, but they don't have control over what they make or every ton of plastic process. And that's why you see the volatility in their earnings and all. Capital misallocation. This has been, this is very important. Early stage, all the entrepreneurs, they are very, very disciplined in allocation. But as they become successful, they become overconfident and they end up chewing much bigger than what they can actually handle. So we have seen the examples of Tata Steel and say Bharti Zen and even Hindalco to start with. So all these large global acquisitions, they have not done particularly well for these companies for the last 10-15 years. And my sense is that this particular thing has taught Indian companies to avoid, because the bankers are very smart from Europe and America, and they bring all these companies with a very, very low cost money attached with that. And so all these Indian companies initially they got, so capital misallocation, even in India, you might end up diversifying into something else which is capital intensive, though you have made money from some other profitable venture. So capital misallocation can actually, it can dislocate the consistency of the company. So these are the thought behind the consistents and volatiles, but what are the number behind? So this is the summary of what we have done. So we ran this 700 companies, 697 companies. So maximum number of profit degrowth is 3, 0 bucket, 1 bucket, 2 bucket, 3 bucket. So maximum is 3, and anything more than 3 downgrades beyond 10% are called volatiles. And we have done it right from 3 to 15. And all these 583 companies are volatiles, and number of stocks in consistent are 114. So look at the percentage, 16% are consistent, 84% of the companies are volatiles. And of that, 87% among the consistents, 87% of the companies are outperformers, and only 33% of the volatiles are outperformers. And underperformers are 13 and balance is 67% underperformers. But look at the return. The Nifty return in this period, 15 years, 9%. The return of this is a little wrong. I think the return is 20% for consistents. And 2% for volatiles. They've written ROE, but the return is actually 20%, and here volatile return is just about 2%. So basically, most of it doesn't mean that all the companies are low return. There are the companies in volatiles also which have done well, but as a bucket, they have done very badly. In fact, bulk of the 95-97% of wealth is created by consistents as a group. So then we said wealth cannot be created only by consistency. There is always a role of growth. So how they have done in growth metrics, and consistents with low growth fared better than volatiles with high growth. So we said on the y-axis we said above 20% growth and below 20% growth, and volatiles and consistent. Look at it, right hand corner top is the best, consistent and high growth. Of course, consistent and high growth is supposed to be, is a very logical. But second thing I thought was that volatile but high growth would do very well. But that's not the case. Consistent with a reasonably low growth, 10, 12, 15% growth, has done better than more than 20% growth from the volatiles. So that's the thing. The real money is to be made in the even low growth, moderate growth. If you get high growth consistently, of course you are going to make tons of money. But if you get even moderate growth of 10, 12, 15%, you are going to win in a marketplace. And during this period, the market performance has just been about 9%. So on the same framework, we looked at the sectors also. So same methodology to classify sectors as consistent or volatile. And here, 18 sectors, starting from I was surprised to see the sectors which are consistent. Agrochemicals, auto ancillaries. Automotive itself is volatile, but auto ancillaries, because they have the after-sales market, they have done much better. Banks, private sector has done well, public sector is completely volatile. Cement, chemicals, cigarettes, credit rating agencies, diamond and jewelry thanks to Titan, engineering, finance, FMCG, IT, logistics, oil and gas, just the Reliance, paints and varnish, pharma, refineries and utilities. So just about 18 industries. Be careful, there are a lot of industries per se, they are extremely volatile. And sectors with not even a single, see, consistent company can come from a consistent sector and it can also come from volatile sector. Though the percentages will be lower from the volatile sectors. But there are sectors from where there is no consistent company. Koi mai ka lal nahi isme se. So, you know, like air transport, alcoholic beverage, I am surprised. Banks, public sector, bearings, cables, your shipping, sugar, telecom. I am not saying this has been the history of last 15 years. The next 15 years could be somewhat different. But core thought process that these are the unreliable sectors. These are the sectors which are not consistent. That will remain. I don't think fundamental character is going to change there. Then we looked at the sector and companies kind of interaction. And here we looked at a consistent sector and volatile sector, consistent company and volatile companies. And here we thought consistent sector and consistent companies will do the best. No, consistent companies from volatile sector, because they have to fight again, double, the industry headwind as well as whatever is the competitive headwind. So they have done better than the companies. There are 31 companies which are, I would say, they deserve a special mention. They have done better than consistent and coming from the consistent industry. And those 31 companies are all here. Astral, Page Industries, TTK Prestige, Eicher Motor, Kajaria, Whirlpool, Supreme, Balkrishna. They're all the companies which are from fundamentally like Balkrishna industry. It is from tire industry, which is God-forsaken. I mean, it goes from loss to profit kind of thing and very volatile in terms of profit making. But Balkrishna has been a continuously profit-making company. So like that, in textile, Page Industry is the star, and all the other companies, large old companies, they have been all over, up and down. Yeah. So reconfirming the findings, we said we have done the 15-year study. Let's look at 10-year rolling. You know what happens in 10-year basis, because it gives a recency, and we said let's look at this one. Really staggered us when we saw the data. So this is a 10-year rolling, all the companies. And across all the market caps, we have defined, so this is a 10-year rolling consistent, and there are two drops in this thing, but definition remains same. Large, mid and small, all the companies, in all the buckets, the consistent ones have outperformed. Just look at the down below outperformances. As like first year 13%, alpha is, for the group, 22%. Alpha is 8%. Like that, if you go and keep seeing, all the years, all these companies have outperformed. As a bucket, I'm saying, as a group. And every single bucket has been outperforming. There is no year, there is no conflict anywhere. And look at the other side of it. This is about the consistence. Look at the volatiles on a 10-year basis. Every single bucket in every single reading, it is underperforming. So this is kind of a sets at rest that the power of consistency versus weakness of volatiles. I mean, it's not that we can forecast every single consistent companies, but when we get one, we should really use it as much as possible, because this particular statistics is absolutely stunning. So then we said, okay, we have seen 15 years, 10 years, let's look at what happens in 3-year basis, because life is not about 10 years, life is about 3 years. Here I think there are a lot of people who are bothered about next 3 days. So we have to, but then there is no investing for less than 3 years, so we looked at 3-year data also. So here what we did, like 2000, 2010, we said let's take 10 years data, and then we said next 3 years what happens. So between 10 to 13 what has happened. So if it is consistent CC, means consistent in the first block and consistent in the second block, it has done about 12%. But hold your breath, when it is volatile and it gets converted into consistent, it is 15%. But if it is consistent company which becomes volatile in next 3 years, it is minus 8%. And if it is a volatile company, remains volatile, it has gone to gutter, it is minus 11%. Like that, we have done all the iterations, and so here is a summary of all the 12 iterations. The average is, if the industry has done about 9%, Nifty has done on average 9%, the companies which were CC, consistent to consistent in next 3 years, is 21%, and from volatile to consistent, it is expected that yes, it has to be highest, it is 28%. And the next two are just about 2-3%. So anybody would say that I would like to buy a useless company which is going to become great, because all the analysts, they give you a story of this company, this useless company is going to become great company, and it never happens. So the probability of making 28% is very low. Probability of making 21% is very high. So you have to figure out where is the payoff matrix in your favor. I think payoff metrics, when the consistent company, that's why Reliance and HDFC Bank, for some time they might look, they are not making money, but they come back and make up for all the past, slowdowns, and they make all the money. So consistent companies remaining consistent, if you are lucky to forecast consistency, are the companies to go with bulk of the time. 31 out of Nifty companies, just on the same breath, 31 out of 50 companies, accounting for more than 72% of the market cap, are consistent. I told you the list is out here. When you take the report, it will all be there. So how to create wealth? Now, everybody is now brainwashed for consistent and volatile, but how do we make money? Because that's the real thing. So then there is another framework which we were kind of looking to, encash on. That is a framework given by Peter Oppenheimer of Goldman Sachs in his new book, Top Buy. So here he's talked about, earlier we used to think that there are only two sentiments in the market. One is greed and fear. But here he has made it despair. This phase is bear phase when the markets are falling. Second is hope. The moment market fall stops, then the hope rally starts. The day on which Modi ji declared the lockdown, that was the bottom of the market. The hope rally started the day on which he closed the country. Then from there the growth phase, and then the optimism. So psychologically, investors do commit mistakes in two phases. In the pessimism, they break down, and in despair, valuations are created. Earnings are bad, but the P multiple drop to the lower earnings. And in optimism phase of the high earnings, people end up giving the high multiple. And that's where the investor psychology needs to be understood and studied a lot more, which we'll take up in the next study, probably, because EPS growth, EPS has been studied a lot, but not so much the multiple changes. So we will come back with a little more deeper study next year, but right now, the consistent and volatile framework has to be combined with the despair and the growth framework. And here, in the entry strategy, when the earnings are predictable, you must use the profit and loss based, profit based or cash flow based, DCF based valuation tricks. And when it is unpredictable, you have to go to the balance sheet and you have to use the asset based valuation, that is price to book, price to capacity. I mean, if the book value itself is zero, then you have to use the capacity. I have 5,000 rooms, or I have a breakup value, basically. I have a 500 planes, or whatever you have. Or price to sales. At least your sales you have. You don't have profit, but you have sales. And then price to, so you have to use the price to capacity. You have to stay away in volatile companies to value it on the earnings based. You have to value it on the capacity based. And also, if at all, buy only large volatile companies, but consistent you can buy as small as possible. So odds of generating alpha, if you buy below median P multiple or below median book in consistent and volatile, is very high, but investing is a lot more creative stuff. You have to be careful in using these tools, but they do give you opportunity to buy at reasonable prices if you buy below book or below median book or below median P. And thanks to a lot of software, you can now see 15 years of median P and price to book on almost like literally free in screener kind of apps. So exit strategy, consistent investors. Now here is the real change. In consistent companies, you can be buy and hold. But in volatiles, you must sell when appropriate price comes. And appropriate price could be 3, 4, 5, because you'll make money very rapidly. When you make money, the story changes because earnings come there. And then people say that earnings P multiple is low. Don't fall for it. If you have made money in volatiles, run because it is going to collapse. And quite possible in some cases, you may miss the top, but you have to sell too soon. But you have to sell in volatiles, but you may not sell. I mean, you may have buy right, sit tight kind of situation in a consistent companies. And so some of the ideas we have put here, and for consistents as well as volatiles, you can see in the report. And so conclusions, the financial sector coming out of despair will continue to dominate wealth creation in the foreseeable future. There are only two types of companies, consistents and volatiles. Consistency is source of outperformance. So every period of consistency is a source of performance, and volatility is a source of wealth destruction. Excellence in execution is non-negotiable consistency. Buying below median valuation tilts the odds in favor of the investor. And let me just leave you with one thought. India is the ultimate consistent country where your GDP, underlying GDP is growing at about 12%. In this first half year, it is 16% growth. So this is a country which gives you like a fantastic bedrock for wealth creation. So with this, you expect bigger and more number of consistent companies coming from Indian corporates, particularly from private sector. So all the best for a fantastic wealth creation through consistent companies. Thank you.
We've got 5 minutes. So anybody who can go around with the mic? Yeah, we can. नहीं लेके आओ दो mic. So you can be on the dais. I'll moderate the.
Moderate कर लो, मैं mics भिजवाता हूँ.
नहीं कैसे अभी I'll ask for questions then people will put their hands up.
I'll have एक mic.
Yeah. Thank you, Raamdeo ji. That was a very insightful presentation. We have time for some Q&A. Maybe we can take a few questions quickly. We've got about 5-10 minutes before the panel starts. So if you put your hand up, I can get the mic to you quickly. Mic. Yeah. Please go ahead.
Oh, mic is.
You need to put it on, I think. No?
Yeah.
Yeah.
This one.
So private banks have gained the market share in the last decade almost on the back of the better technology, better branches, and all in all, many reasons are there. In the last two quarters, PSU banks have gained the market share. So what's wrong with the private bank that they have lost their market share? And what should they do here on to gain the market share again? Or we can say that it's a mean reversion for the PSU sector in terms of market share.
Market share in businesses, or you're talking about market share in the market cap?
Businesses.
Businesses. I don't have the data for that PSU banks have done better than, I would be very surprised. As a group, you think you have the data that PSUs have done better than
yes, in the last
sector?
2 quarters they have done better than the credit growth what PSUs have shown is are the better than the private.
Okay, the bankers are coming here, you can ask them. I don't have that specific data about the breakup. But over a period of time, they have, I don't have any specific reason for that. Maybe the base is low for the public sector banks, and they have got the respite, they have been, they have got this opportunity, this credit cycle. So, very counterintuitive to say that public sector banks will outgrow, I mean, that will be a fantastic thing to happen. If by chance public sector banks are also able to at least retain their market share. So that question definitely we are going to ask the bankers here, and I think you will get more intelligent answer from them rather than me. Okay.
So, Malab, do you don't think that mean revision can happen for the PSU at this point in time?
Not in the business side. Valuation side, yes. I mean, if you have beaten down them below book or below half book, then clearly that half book can go to, like SBI has moved between half book to 2.5 book. Now it is at 1.8 book. So what stops them from going to 2.5 book like private sector banks? So that can definitely happen. That probably is happening and will happen, I would say. But in fact, that is a great opportunity and that's why we have said financial sector per se, private as well as public, both are looking to be very good opportunity for investing in the few years ahead, because the credit cycles are not 6 months, 12 months kind of phenomenon. It typically runs much longer, like maybe 8-10 years, and that's why interest sensitive sectors like realty, that also could be one of the interesting things. So that's our thought process. I think Latha and other people, they would have better view of what is the longevity of this credit cycle, and if it remains a 4-5 year phenomenon, then I think all the NBFCs, all the even not such a well capitalized public sector banks, they would also do very well. And since they are beaten down in terms of valuation, then the chances of percentage gain is much higher.
Thank you.
Great. We have time for 1 or 2 more questions. Yeah, here. We have a hand up here.
Good evening, sir. This was a very good presentation. But have you analyzed the relationship between the consistents or volatiles along with the corporate governance or, accounting cleanliness?
Yeah, so that is part of the company's strategy and execution. I mean, you have to execute in a very clean way. So that is there, but it is very difficult to, I mean, it is a case by case. What you are saying is very valuable. I mean, you need much better corporate governance for companies to keep growing and keep remaining profitable or being competitive or even leader. So those characteristics have come, and transparency and good governance is part of it. But to put it in a place when you are running 700 companies' data to pass a judgment which company has a good corporate governance, which don't have, I think that requires a very micro, interaction and view taking for every individual company. So we have not. It has crossed our mind, but we didn't find any way to do justice with large amount of data.
Thank you, sir.
Yeah, there, behind.
Sir, I have 2 questions. Towards the end of your presentation, you mentioned that India is a consistent. My question is, how do you see climate change affecting the Indian economy in the foreseeable future? And my second question is in line with the previous question that was asked by the previous person who raised the question about transparency and accounting. In European countries, drawing from United Nations principles of responsible investment, there is a lot of focus on ESG funds. How do you see ESG funds playing out in the Indian economy? Thank you.
So, climate change and all are much larger issue, and India is also trying to do its best. I mean, though it's a much smaller emitter compared to China and America, but still we are playing our role. But these are the issues which are very large and very long range issues. I mean, I would be very surprised if the India's growth story. I mean, I'm not an economist, but India's growth story of 5, 6, 7% real and 4-5% nominal. I mean, additional inflation giving you 10-12% kind of a nominal GDP is under any kind of threat from these factors. I mean, those things are there. They might, at the margin, reduce the. I mean, if we don't do a good job there, maybe the growth might come down from say 12.5% to 12% or 11.5%. But I think this broad trajectory and ambition of the government and where we stand, average annual GDP of the world is more than $10,000-12,000 per capita. We are at $2,500. So we have a lot of headroom for keep growing at about 6-7% for very long time to come. So I would think that those issues are important, not to be put under the door, but I don't think that is going to impact the march of India, at least for next 10, 15 years, the way we have seen in the last 40 years.
I think there's one hand up here. If whoever is passing the mic, I'll come. He had already raised his hand. ये यहाँ पे आगे.
Good afternoon, sir. Thank you so much for the lovely presentation. I have a very basic question, and I thought there was a bit of an anomaly in this presentation which we had here today.
Yeah.
The wealth destruction companies, to my mind, per se, when we look at this list, starting with Vodafone India right down to Bosch, seem to be consisting of companies which are clearly in the consistent space. So the consistents have turned to be bummers and have lost money for the investors, whereas none of the volatiles of this list of 10 seem to be. So that was some kind of a, a question which I had. I mean, how come they don't dovetail into each other?
The consistency of the sector doesn't guarantee you consistent company. So you can get volatile companies from consistent sector, and of course volatile companies you'll get from volatile sector. Whereas at the same time, you can get consistent companies from consistent sector as well as volatile sector. Like that, well destroyer can also come from anywhere. So yes, I mean, I told you that this time a lot of credible names are there which are very large well destroyers. But that's unfortunate. Like Vodafone is by far the biggest. It's 1,27,000 crores. This is a large number. But I mean, this is a sad thing to happen. 3-player market, and yet the third one has been, I think they were by far the largest actually in terms of market share. So, but everything happens. This is just a statistical thing. Whatever has come, we have just talked about it.
I think we can take one last question from here before the panel.
Yeah, good evening, sir.
Yeah.
First of all, thanks for such a wonderful knowledge sharing. And in one of the slide, there was a data regarding when a consistent is shifted in from consistent to the volatile.
Volatile, yeah.
And vice versa.
Yeah.
So I want to understand what are the key reason behind a company when it get shifted from consistent to volatile, when this crossover happens.
From consistent to volatile, there can be so many reasons for consistent becoming volatile, in the sense that, like say telecom. Telecom was a consistent sector till about 2006, even till 2008, and then suddenly it became the worst of the volatility for next 12 years. So that was the intense competition from this sector. So whenever there is a disruption by themselves or government intervention or some external factor, like say COVID, if the COVID kind of thing happens, instead of 2 years or 5 years, a lot of consistents will become volatiles because it's all statistics. So in businesses, a lot of these things can happen. You have to understand the past consistents becoming volatile individually rather than in a bucket.
Thank you, sir.
Yeah, thank you. So that was the time for Q&A. We are ready to start the panel discussion. So we'll always have time for interactions after the panel. Mike? Not it. Great. Thank you, Raamdeo ji. That was a very insightful presentation. And from today, I think the world of stock markets is split into two halves, the consistents and the volatiles. We have a very, very interesting panel discussion to follow now. And to take you through the panel discussion, we have two giants of the financial services industry who will join Raamdeo ji. Now, to moderate this panel, we have another stalwart from the media industry, Latha. Latha has been one of the keenest observers of markets, RBI, interest rates, everything macro. And she's won several accolades. She's won the Ramnath Goenka Award for Excellence in Business and Economic Journalism. So, without further ado, let me first invite on stage Latha to join us. And she'll be leading and moderating the panel. Our first panelist is actually a giant in the financial services industry. I mean, Mr. Keki Mistry. He's the Vice Chairman, Chief Executive Officer of HDFC Limited. Mr. Mistry joined HDFC in 1981, and he was appointed as executive director way back in 93. And he's on various panels, and more importantly, I mean, he's like a legend in the financial services business. So welcome, sir, to the panel. Our second panelist is Mr. Amitabh Chaudhry, again from this. He was in the same institution earlier, but now he's the managing director and CEO for Axis Bank. And Axis Bank, clearly we've seen over the last couple of years, has set in place a transformation strategy which is showing in the business as well as in the stock price. So Latha, over to you. Yeah.
The amazing consistency actually comes from the Motilal Oswal Securities Company, or Raamdeo. The consistency with which for 27 years the wealth creation studies have given gems in terms of ideas and ways of thinking to pick stocks and stay with the good ones. But this one I think takes the cake in terms of understanding stocks in the form of consistents and volatiles, and the arithmetic showing that staying with consistent stocks has helped. I will of course quiz him on that, because there are ever so many times when volatiles attract us. But it's very important that, to bring out the theory, he has two people from the financial sector. The financial sector is an amazing place to study this theory, simply because it has a good number of consistent performers as well as volatile performers. It has the best of the breed, if you please, HDFC Bank and HDFC, which for the longest time have given consistent returns, and we have, of course, extremely volatile performance coming from public sector banks and even some private sector banks, at least one. Then you have the financial sector itself, NBFCs. Again, you have an extraordinarily consistent performance coming from Bajaj Finserv, which I think is in the consistent list, and a large number of volatile performance. So it's best to understand from someone representing the consistent space, and someone has almost taken his bank from the volatile to the consistent space. I think the best two people to guide us as to what is permanent and what abets consistency. Thank you very much, Mr. Mistry and Amitabh. Well, first, Mr. Mistry, both HDFC and HDFC Bank have been able to give an extraordinarily consistent performance. If you can identify for us what is controllable, because banking is essentially cyclical, NBFC is essentially cyclical. What is controllable, what is not controllable?
I think if you ask me, Latha, there are relatively few things which are uncontrollable. Relatively few things. So sorry, I differ from what you said. What is uncontrollable is interest rates. What is uncontrollable is the economy. What is uncontrollable is currency. But if you run your business well, if you keep the strongest form of risk management practices, or you adopt the strongest forms of risk management, you will generally always be consistent in your results. I mean, I remember something like 25 years ago when I first started meeting investors in the 90s, and Amitabh knows we talked about it. All our investors at that, I'm talking of the late 90s, sorry, not early 90s. A lot of our investors were coming and telling us, you're losing market share. Because there's this private sector bank which is just coming and, taking market share. And I remember telling all our investors at that time that we are not in a market share game. We have consistently kept for ourselves certain objectives. So what are those objectives? Our objectives is that our return on equity must rise in those days by 100 basis points a year. Our cost-income ratio must be must be single digit, and must keep improving year after year. We must target a growth of a certain percentage, which is then a function of how the economy worked. But we would give quality service, we would manage our assets and liabilities, we would not take short-term money at low rates and lend it, for long-term and take a huge maturity mismatch, which would backfire if suddenly interest rates go up. So we had to take in a lot of these kind of checks, put in these kinds of checks and balances in our business, and that brings about consistency.
Well, you will have to admit that perhaps a bit of financial engineering also helped. I mean, it's, at least with HDFC Bank, the analyst perception always was that in good years, some of the money was kept aside in provisions or in other areas. And at times, say like 2009 or 2008, in one of those volatile years, or maybe even 2002-03, when we were just turning up, all those were also factors.
I don't know about HDFC Bank, but I can tell you one
You
thing.
do know about HDFC Bank.
But let me tell you generally that today the accounting standards in India are so sacrosanct. For a bank, there are ways and means in which you can create a buffer, you can create a provisioning. But if you're following INDAS accounting, Indian accounting standards, the new accounting norms, which all NBFCs, housing finance companies do, you cannot do that. If I want to make an excess provision, I have to identify a loan against which I make that excess provision. I cannot just make an ad hoc XYZ amount provision. You can't do it. It's not possible. In the new accounting norms. In the old accounting norms, yes, this was possible. You could create
some
a provision.
elbow room for keeping reserves. Amitabh, actually a similar question to you. In your playing, I mean, you have been a banker and then you had a stint in insurance and with a group that is known for consistency, and then now back to a bank which showed volatility. You stepped in when immediately after the asset quality review, so there were problems. So if you can identify, can you have consistency factors and uncontrollable factors?
So just building on what Keki very articulately put forward, that there are uncontrollable factors, a few of them. I think there are some more. End of the day, the geopolitical situation has had a huge impact across the world. We had this pandemic, which was completely uncontrollable. There are technology risks which are emerging daily, continuously. And you have seen players which you could not imagine 5 years back coming and wanting to play in your space. So there are these uncontrollable factors. But I think as Keki very correctly pointed out, ultimately, if you have the right leadership, if you have the right principles in place which you consistently follow, if you believe in certain parameters, I think the biggest part of consistency in my mind is defining what you will not do rather than what you will do. I think a lot of people focus a lot on what they will do, but I think they forget to tell the world what they will not do. And because they don't tell them what they will not do, they just keep doing stupid things in the process. So I think if you even hear what Keki said, he said we defined our risk framework. We were not in the market. The word was not in the market share game. So I think he defined what they will not do.
Define your don'ts.
Don'ts. And I think once you do that, you have the right leadership. You're obviously anticipating the uncontrollable factors in the environment and reacting to it. So worse situations will happen. But what you make out of...
Market share at any cost is a don't. What else is a don't?
No, the biggest don't is what is the value system you have. And what value system will you carry through? And I think if you look at HDFC as a group, I think there is a certain value system they've stood for, and I think that has stood them in great. I've worked with the group, I've learned a lot there, and I think that has worked wonders for them. And I had a opportunity to work at Infosys. I think you've seen similar traits there too. So one is the value system. Second is businesses you define what you will do, what you not do. Third is that I think you need to know what will differentiate you from the marketplace. If you want to deliver consistent performance and manage these uncontrollable factors, there's something you should be known for, because that will hopefully carry you over the tsunami or tide, whatever comes through. And I think if you have either, you're a leader in the market, or you have a certain market share, or you're respected, or you follow certain consistent principles, your performance will come through. You will dip, but you will always be rising above the rest of the players. They will suffer much more than you. And so, based on the definition, what I see of consistent players, you will hopefully stand in good stead. So, I think Keki wants to add.
So the don'ts are, go ahead.
Sorry, can I just add one thing? You asked what is it that you should not do, and to create consistency. You take the example of 2018. ILFS went. You had a period of 4 years where interest rates were extremely low. So you had so many NBFCs, and I'm not naming anyone, but so many NBFCs which went to the market and raised 3-month, 6-month money and used that money to give 3-year, 5-year, 7-year loans. So the yield curve was reasonably flat. You could borrow money at an extremely low rate and lend money at a high rate. And when your liability matured, 3 or 6 or 9 months, whatever it was later, because interest rates continued to remain benign and in fact were going down, you could refinance your liability at an even lower rate and expand your spreads and increase your profitability. But then when the crisis happened in 2018, it caught up with everyone.
That's a fair point. Actually, I was going to come to that 2018 point when it almost looked as if the banking sector could yield place to NBFCs. We heard so many speeches to that effect. Raamdeo, as the neutral observer, what do you have to add to this in terms of, what did the consistents get right and what did the volatiles get wrong?
Yeah, I think we have a very interesting situation here. I mean, here is the epitome of consistency coming from house of entire group. I mean, HDFC. I think they have an ethos around how to manage the risk and maybe risk arising out of counterparty risk. I mean, whom they do business with, because it's a business of lending. So clearly, that has been the cornerstone of, and I used to, I mean, whenever I met Mr. Parekh, he used to say, learn to say no. So clearly, they have not only said so, they also practice that. So clearly, I mean, HDFC story is very well known. We have read all the balance sheets. But I think the real most interesting thing is Amitabh's situation, where UTI Bank or Axis Bank was one of the fastest growing and most consistent bank between 2000 and 2015. It grew at mind-blowing 38% compounded, year after year. There is no year of break. And then comes 2015, I don't know what happens. Maybe the corporate loan book blows up or something like that. And you have, still, I think this is the first year of consistency, I would say. I think the moment he got into the saddle, COVID happened. But now I think he's got, I mean, now the stock has gone, I think the profits are also, it's a very first year. So a lot is to be said. I mean, it is clearly visible in the graphs. I mean, what has happened in Axis Bank. I think Amitabh can throw some light. Maybe he was not there in those 15 years, but he would know what really happened in those 15 years and what went wrong in next 5 years and what is going to go right. I mean, are we seeing emergence of one of the, because he has been trained to be consistent bank. So what is the challenge of making this volatile bank into a consistent bank?
What HDFC elements are you bringing into Axis?
Thank God I'm sitting and talking here when at least the last bar is there. Otherwise, I don't know what I've said. Now I can give some speech, maybe not like Keki, but at least some speech. Obviously, what happened after 2016 was we paid for some of the mistakes we had committed in the last 5 years. So we paid for not only the principal which never came back, but we also paid for the interest which we recognized as income. And kind of that also we had to recognize as losses during that volatile period. COVID did not help, so there are 2 years of COVID in it. I think, but it also gave us an opportunity to set some things right. I mean, we had launched what we call the GPS strategy, but S stood for sustainability, which is all about sustaining consistent performance. And sustainability had some very simple elements to it. Becoming more conservative, moving towards process excellence, improving your execution, more pristine quality in terms of assets, more ensuring that the risk guardrails are tight and they cannot be interfered with, ensuring that the credit and business are separate. In our case, they were within the same department, so the business could decide whom the money had to be given to. So we did a lot of those things, and the problem with sustainability is it takes time to come through. I'm not saying the journey is over. I think it's still a journey we are on. I think the system will test you because people who worked in a certain environment for the longest period of time will come and test the door, whether it can open a little bit like it used to open in the past. And you have to be very, very firm. So this will take a little bit of time, but yes, our graph does show that we have reached a level of granularity in our business. Earlier it was performing for the next quarter. Now we have started thinking how it will look like for next year because we know what the next quarter will look like. So our prediction and our projection on what we can do has improved dramatically. And slowly, gradually, I think we should be able to lock in a year at a time as we move forward, in spite of whatever we might see in the external environment. Obviously, external environment can come and change things a little bit, but broadly, where you'll end up. And frankly, for me, if a business cannot project what they will do in the next 12 months based on what they see today, I think sometimes they, in a way, don't know. And I've learned this when I used to run a BPO company. In a process, forget about a company, in a process, if you really measure the process well, you should be able to define upfront what is the quality I will deliver month on month for the next at least 3 to 6 months, if you know what you're doing. So I've just, picked that up from there and build on it, and the same thing can be applied to a business. So you need the right process in place, and I think that's what HDFC Group has done consistently in HDFC, Limited itself, and then obviously a lot of other companies in the group. All of them have consistently shown performance. And we are trying to do exactly the same thing in Axis Bank. Please understand that when you go through a transformation like this, there is a lot of short-term pain. Because if you start taking decisions for the long term, there is short-term pain. because you're trying to remove some of the problems which exist. And you cannot keep talking about the short-term pain all the time, because then people say that's all you have. Your story only is to blame the past. So you have to just take it, absorb it, and keep moving. And hopefully the numbers will show. So we have, as you said, we are just getting there. A long way to go. I mean, we have a track record of HDFC which goes on for decades. We have, we're talking about 1 quarter and trying to build a line here. So we have a long way to go. But I think we have put the granularity in place. And that is a combination of so many things you have to do. It's not just one thing.
Basically become an SOP bank.
You have to be. Otherwise, ultimately, as end of the day, the banking business is very complicated, but it's very simple also. You just have to do some of the things right. You need, in P&L is only 4 big items, end of the day. There is rent interest income, there is fee, there is, your costs of doing business, and credit costs. I mean, I know I'm making it very simple, but you need to manage 4 items in P&L. You just need to focus on how will you manage them, what are the principles you'll use to manage them, and I think once you get them right, things do fall in line. And I'm sure Keki can write a book on this, but I'm just making it very simple. So he's the god here.
At the moment, it looks very attractive to actually buy public sector banks, because it looks like some process of, correct management principles have been learnt in the public sector bank, and certain institutions have come, like Krilik. I mean, probably if Krilik existed earlier, the banking sector may not have gone through that kind of an asset quality review. So, I mean, how do you explain that? Is it possible that not just a company, but a sector can go from volatile to consistency for a period of time?
Of course. I think that's why we are saying that financial sector can go, the credit cycle could last for, you would be better judged to say how long this credit cycle will last. But if it lasts for 7-8 years, after that, a decade-long washout, if the country gets consistency, credit cycle gets consistency, both are interchangeable. If that happens, then all the companies, all the public sector banks, they were beaten out of shape. Half book, 0.4 book, 0.3 book. So one is that you have the investor psychology which has completely hated these companies, and you might have seen the presentation. All the PSUs, forget about PSU banks. There is a zero wealth creators. In 2004-05, 40% of the wealth was created from them. Not a single PSU has stood up to become a wealth creator. So clearly, it is a complete reaction, and everything is not justified. Every private sector company is not as well run as all the public sector companies. Yes. So I think there is a hope at this point of time, particularly public sector banks, that the reversion to mean will happen in terms of at least multiples, the price to book.
How do you pick within that public sector bank? Do you look at management quality, CEO quality? How do you?
Yeah, there also, given the restrictions or the challenges of working within public sector in HR policy, compensation policy, promotion policy, what they can do, what they cannot do, how much social sector they have to do. So those things, keeping that in mind, again you have maverick leaders who are they come for 3-5 years, but they do make a difference. So if you have this kind of environment where you get very energetic and very good banker to lead a public sector bank, I would say that those are the banks which could see much high, because see, private sector is trading at around 3 book. Public sector is trading at
0.3.
Not 0.3, now say 0.8 or less than 1 book. So clearly there is a scope, and particularly when the consistency, see, wealth is created during consistent period. And I think the backdrop is for consistent performance of averagely run banks and NBFCs. So as the consistency continues, I think people are going to move from a consistent old like private sector banks where they gave fancy valuation. They would say, okay, here is consistency. Let me put some money from there to here. And that's why leader of the pack is SBI, which traded at 0.5 book in 20. At 150, 160, it was a half book. Now book will go at 15%, and if price to book goes from half to 2.5 at the peak, you are looking at 7 to 8 beggar from the bottom. So it has already done 4x. Maybe another 3-4x is still in store if credit cycle works. But that doesn't take away what can happen in the private, because these banks, they are super banks, all these private sector banks. They have a huge incentive structure at the leadership level and highly competent this thing. And the most differentiating factor I see is the technology. And technology is a very consolidating factor. It's not very democratic. 20 licenses doesn't mean 20 players. I mean, one bank can be 20% market share. I think that's where I think likes of Amitabh, who have little technology background also, have chance to create a bank of disproportionate size in next 10 years. And, you know, one of the things which was coming to my mind is that the first debacle in Axis happened because of corporate loan book. Now, seeing that, all the banks are saying we want to build a consumer book. My sense is next blow up is going to happen in consumer book. Because corporate book will be, there is IBC code, and borrowers will be cautious, and lenders will also be double cautious. So what will happen is maybe I'm not saying that Axis will do that, but the caution might be required in building up unrelented consumer book. Do you think anything like this can happen for the system per se?
See, if you look at all the commentary on the retail side of the balance sheet, I think that commentary or that fear and worry has been there for quite some time that the retail book could go south for the banks. I mean, this was been said pre-COVID also. You know, the cycle has gone on too long. One day it will break. My view is that, please let's understand, there is a risk-reward curve and a risk-return curve where the banks, even let's say HDFC and some of the bigger banks, are playing on the lower end of the risk curve. They're not, you know, lending to anyone out there. There is a long tail of NBFCs. There is a long tail of public sector banks who are getting into this higher end of the risk curve in my mind. So one is that, firstly, we are playing on the lower end. Secondly, I think as information flow has improved in the system, and if you can, from using technology, using AI, using analytics, can absorb that information which is coming to you, your ability to underwrite, frankly, every Indian is improving. Forget about the, you know, the right kind of customers. They are overbanked. But your ability to underwrite every Indian is improving dramatically. You look at account aggregator platform, now GSTN has also been added to that platform. So as more and more information becomes available, and as you move with that information, you create the ability to absorb the information, understand it, and, you know, being able to underwrite the customers based on that. I don't think if the banks get it right, they will lose money. I don't think so. Yes, in a cycle you could lose a little bit more, but all of us have now such sharp and such well-defined policies on provisioning that if there is a slight deterioration, the self-correction mechanism also kicks in very, very quickly. So, you know, I'm not saying that the losses could not go up, but if they go up, they will go up marginally only. You will not see a bloodbath in terms comparison to what you saw on the wholesale side where large amounts went down. So I would say that the larger banks, larger institutions are better protected. The information flow will help. They are at the lower end of the risk curve. But yes, if someone for growth purposes starts going a bit berserk, things can go wrong. But
can technology take away the game? See, that's what Deputy Governor Ravi Shankar actually chided the banks the other day at the IBA, saying, you know, UPI came to all of you. Why didn't you all create the Google Pay?
We did not have 3,000 crores of money to, you know, make a loss on. Mr. Raamdeo Agrawal would have killed us by then if we had spent 3,000 crores in just creating a market share of UPI.
Banks together.
No, that's reality, Latha. That's reality.
Banks together could have done it.
If you had formed a subsidiary where Mr. Raamdeo Agrawal would have taken equity and allowed us to spend 3,000 crores, we would have spent and taken that market share. Today, that's a problem with technology, that if there are companies who are being funded through capital, who can then spend that money to acquire customers and make huge losses and get more value in the process, banks or the institutions that have been around forever cannot afford to play that game. So we have to play the game slowly, build brick by brick, and hope that our technology will catch up. One. Secondly, we hope that these valuations will go away, which has happened. And hopefully in the future, this capital will not flow the way it has flown in the past. Now, unless these players, which are being talked about by the Deputy Governor, very rightly so, they do some other business. This business makes no money for them. So they have to do something else. So what are they doing? They're talking about NBFC license. Moment they talk about NBFC license, RBI said, okay, I'll govern you. They don't want to do that.
RBI is batting for yours.
So yes, no, but RBI is saying come through the front door. If you want NBFC license, come through the front door. So my view is that end of the day, yes, they have gained market share, and yes, the banks have been slightly behind, but if they want to make money, as I think you have said, Mr. Agrawal, so many times, that ultimately cash flows need to show up. Ultimately, that's how the valuation will be based. So I want to see where the cash flows are. We are working with these very entities, and I think they are playing two games. One is that they are trying to ensure that they become a distribution channel and they collect a toll on the way, or they will themselves become competition for banks. And competition is welcome, no problem.
Well, actually, I was going to come to the technology as a theme a little later, because I wanted to get from Mr. Mistry about the merger. I mean, that's a large bank now. 18 lakh, 19 lakh crore. Is this consistency possible?
If you ask me honestly, and I genuinely mean it, I think the growth can only accelerate. Because from the bank side, let's assume that the bank's balance sheet is whatever, 13 lakh crores. That 13 lakh crores has been growing at 18 to 20% a year and can consistently keep growing at 18 to 20% a year. Then you look at HDFC. Our balance sheet, individual loans is say 5.5, 6 lakh crores. In the last quarter, we grew at 20%. And if you look at the CAGR over the last 5 years or so, it's about 17 to 18% in terms of loan book growth, individual loan book growth. Profits may be higher. So that 17, 18% growth was coming about without using the distribution machinery of the bank. The bank has something like 7 crore customers, 70 million customers, 2% only of these people have taken housing loans from HDFC. So look at the ability to cross-sell to a larger group. The bank has close to 7,000 branches.
You all could have cross-sold even before, no? After all, you're all in the family.
In a way, we as HDFC Limited did not want the share of loans brought by the bank to be more than a certain percentage of our total business, because at the end of the day, we have to have our own distribution platform. Secondly, the bank has something like 7,000 branches, but distribution of housing loans all this while has happened from probably less than 2,000 branches. So it's a huge, huge market. So in my view, assuming that the feel-good factor in the economy will continue, which I honestly, truly believe will continue, I would think the growth can only accelerate. Does that make it consistent?
Yeah, Keki, if you look at the data, HDFC Limited has grown at 20% compounded, which is for last 22 years. And stock has also given 20%. So G is equal to R. So that's been the formula. And from here onwards, the credit cycle itself is like 15-70%. I would think that for such a competent underwriter, for them to go 2, 3, 4% higher than system growth should not be a big challenge. I would agree with you. But I think the real thing is, I think that we all can see from outside. The issue is that, do you think the new management, very sudden types, the kind of a management team which has come up, yes, of course, the HDFC Bank, and then on top of it, this merger. So do you think it will be, because 20% on 18 lakh crores is like 2-3 lakh crores, almost a second, third largest bank being created every year. So, I mean, what you all have done in last 25 years itself is unbelievable. But I think what will happen in next 4-5 years of creating 3-4 lakh crores of balance sheet with impeccable underwriting capability, that would be even bigger thing which will be achieved in next 4-5 years.
When SBI was 20 lakh crore, they were growing at single digits, 10%. When SBI was 20 lakh crore, which was not very long ago, before the 5 banks merger, they were 20 lakh crore in 2017.
I mean,
they could manage only single digits.
Let's forget about comparisons. Comparisons are not relevant. I think what is relevant is that, as I said, the people you are talking of in the bank are the same people who've been there for the last, 25 years. It's not that it's a new bunch of people who come in. So the ethos, the culture, all of that is already set in. Growth opportunity, I personally feel very strongly can be much, much higher. How does it matter whether it's 20 lakhs or it's 30 lakhs or it's 40 lakhs? Your distribution is there. Your distribution platform is there. The distribution has not been used to the extent to which, it has potential to be used. If you look at our own customers, 70% of our customers do not bank with HDFC Bank. A lot of them are happy customers, people who have taken a loan from us, people who have a sense of well-being towards us. If we go back to all these people and say, look, we are one entity, why don't you shift your savings, current, etc. accounts with HDFC? I think we'll meet with a lot of success. So there is a massive, massive cross-sell opportunity which opens up.
Yeah, maybe globally all the large banks are not person-dependent. But here, I think in India, because the managements have stayed in the saddle for a very long time, so there is some kind of anchoring around a name. So do you think we'll be able to get over, this particular kind of phobia, or because there is a change of name, change of leadership, and that too after 40 years. You have been there for 40 years. Now the entire guard is changing for across the board. Every bank here. So what do you think, how do you see, sitting outside, how this journey will happen?
So Raamdeo, people are the same. I mean, you may have one individual, two individuals, three individuals who will not have an executive role in the merged entity. But that is because of factors which are beyond anyone's control, age limits, RBI limits, so on and so forth. But the people down the line, the people who are generating the business, the people who are doing the business, it's not that as CEO, I or Renu or any of my colleagues at the senior most level are looking at individual loan appraisers or corporate loan appraisers. We are not. It's just an automatic machinery which you have to put in place. Once you put it in place, it just keeps growing by itself. You have to ensure that people are there. You have to ensure that that the turnover of people is very low. Our attrition rates in HDFC is about 4% a year. So the same people have been around for years and years and years. Who will continue to be there.
Amitabh, what is your best guess of how long this good cycle can last? I mean, once again, I think I asked you this question even earlier. The bottom, when I started covering banks, was 1999, 2000. Went through very bad times. And, once all that correction happened, we had a clean 10-year run. Now what? We should consider the bottom as 17, 18 perhaps. Is this a 10-year run?
Well, I do believe that the cycles are shorter than before now, because I think the world has become a more unpredictable and volatile place. So to assume that we can have a 10-year run, well, it does happen. I hope it happens, but I think in our minds we should be prepared that maybe the cycle will not last that long, because there are too many fools around in the globe who can do stupid things, and we have seen that, examples of that. The second thing is that, yes, obviously we're in a unique situation. India is uniquely placed, and all the parameters, as Raamdeo pointed out, are all pointing to the fact that we are in a long-term credit cycle. And obviously different banks are positioned differently to capitalize on that opportunity. We are hopefully going to see a GDP growth rate in India, given where its positioning is and what it is doing and what the government policies are and stability around that this should continue. But my biggest worry is the risk around global factors. And global factors playing out in some ways which we can't imagine today. And the world is so connected now that for us to believe that we are isolated also is not possible. So, and we have seen in the last 3-4 years how it has played out. COVID, then Russia, Ukraine, then what has happened with China's reaction to COVID, then some of these things which keep happening all the time. A fact that a Korean insurer decided not to call on its what they call the perpetual bond suddenly led to the spreads blowing out. It was not because something happened here. It's something happened to the private Korean insurer. So imagine a private Korean insurer could blow out your spreads by 3 to 4% overnight. So that's what I mean by these global factors. And I think we have to be prepared for it. And the companies and the institutions who prepare for this volatility, I think it's not that this volatility will remain forever, but if you're prepared for it, you will actually get an opportunity to capitalize on it and move forward. Because you react much better to any problem which comes your way. Others are, scrambling. And I think in this volatile environment, where it might not last that long, I think the companies who prepare for it well, frankly, can become even more consistent because they do some of these things better.
Raamdeo, is too much of good news a bad thing? I'll tell you, this tectonic shift in favor of India, I've heard this before in 2005. So sometimes it scares me. But do you think now we have a secular run, or we should be afraid of, good interpretations?
Yeah, I'm seeing only data, and a lot of participation from retail and all, what we do. But actual businesses, the companies, businesses, they are coming to them. And particularly Amitabh, and and here the real estate, that's after 10, 12 years, the cycle is good. And it has a power to, I would say, one of the thought process was that, can the reality, which was in fire in 2004, 5, 6, 7, and then completely out of shape, and literally the biggest of them were in bankruptcy. Do you think we are into golden era of realty companies doing, because the opportunity size is very large, and they have learned their lessons. But they're still same guys. Sab, kya bolu? So do you think these guys can be seriously large corporates doing 20, 30,000 crore sales, 50,000 crore sales, and profits of 8, 10,000 crores? Can we see those kind of things emerging out of...
I'll come to that, but just take off to add to what Amitabh said on the growth part for India. I honestly believe that the growth for India is there for a very long time. Now, whether it is 5 years, 10 years, it's very difficult to say. There are factors which we need to consider, oil prices, geopolitical issues and stuff like that. But India is so much more insulated from what happens to the rest of the world compared to China or compared to most of the other countries, because we are self-sufficient. So long as we can create jobs for our people as they pass out from business schools, there will be growth. And the penetration levels of any, if you're talking of financial services, is extraordinarily low. One of the lowest of any country in the world. If you look at mortgages, 11% of GDP. If you look at credit card penetration, one of the lowest in the world. Similar, our car loan, retail credit, consumer credit, you name it. So the growth is there for very, very long. Now, you're talking of builders, right? All right, so if you look at the real estate sector, again, the penetration level is extremely low. I think the first thing you need to understand is that India has a young population. 2/3 of our population is below 35 years of age. The average age of a first-time home buyer in India is about 37 or 38 years. It's not a 20-year-old fellow like in the US who's buying a house. It's someone who's 37, 38 years. And 2/3 of our population today, therefore, have not even reached a stage where they will want to buy a house. So the growth path ahead of everyone is huge, enormous. Now, without getting into specifics of developers, I think the demand for housing will continue unabated for very, very long.
But that was there between 2010 and 2020 also. And we saw the biggest disaster. So I'm not talking about the demand side.
No,
I'm saying that execution.
Yeah, so
do you think
sure.
it will be a consistent period of profit making for this sector?
So I think what happened, Raamdeo, is that between 2016 and 2018, there were several changes that happened which refined, which modified, which sort of made the real estate sector more transparent. What were those changes? First, you had the elimination of black money, the demonetization, which took out a little bit of the demand. Then came the Real Estate Regulatory Act, which brought in so much of transparency in real estate deals. Then you brought in the GST on under construction properties. Now builders have got adjusted to that. So many factors happened which were not prevalent prior to 2016 or 17, which took builders by surprise, and therefore you saw the stress in the real estate sector in the metros. But now there is much more transparency. Now people are used to GST. They factor in a higher amount of equity. People are not going on a land buying spree. You're not seeing developers going on a land buying spree. People are watching their balance sheets. People are not letting their leverage go too high. So,
well, I mean, I'm assuming the question I'm going to ask Raamdeo will interest you all. It's not to do with finance. It's to do with his theory of consistents and volatiles. You know, volatiles have made a lot of money. Like last year, steel. If you jumped in at the right time and jumped out the right time, you would have made much more money than in the consistents, right? Likewise, now public sector banks, it looks like that. You got in at the right time and get out before it's too euphoric. There's money. How do you identify the in and out points?
In volatiles?
In volatiles.
Yeah, so in volatiles, when the first thing is you have to look at the larger companies so that, I mean, even if it doesn't work, you don't die. I mean, these companies don't go out of scene, like a Tata Steel or a SBI. I mean, they are inevitables, whether they are volatile or consistent. So they will be there. There is tomorrow for them.
Capital is not wiped out.
Yeah, so what happens is, when there is a bad time, the psychological pressure on the investor is to dump and don't go near that. And that despair mode breaks down the valuations below values. And that gives the opportunity. But at that is not my type of investing. I was always teji mein teji, mandi mein mandi. That was my thing before this study which I have done right now. But the way to really play smartly the volatiles is to buy when things are broken, and all the sell side guys, there will be one or two guys who will definitely come out and say, sir, now tide is turning.
So now oil companies are in that position, you
I think the completely despair valuation is in oil sector, where 6 lakh crores, 5 lakh crores, 6 lakh crore companies, consumer companies, they are all consumer companies. They are available at like 0.1 time sales, like 30,000 crores, 25,000 crores, and they have assets in square kilometers. And I mean, they are the backbone of the economy, and they are free pricing, mind you. Government has not allowed them free prices now, in the sense that they have used their P&L, but
for the fisc.
yeah, but they are also not going to reduce the oil prices.
They don't want to kill the golden goose.
Yeah, so they are going to make up. Yeah, so when the profits come back, there will be there will be a lot more hope. And I hope they don't again make this particular companies more volatile. So there is an see, if you buy at 0.1 time sales, you can't lose.
You can't go wrong.
You can't lose, but you could be in trap for some time. So that's the thing.
Now,
And in 1 year's time, you could be sitting on two bagger or three baggers. So you have to play the game. Like, see, one sector is the oil companies, but that is public sector. But digital companies.
I was just coming to that.
Yeah.
Would you buy the e-commerce companies?
Yeah,
I mean,
1 year
we've
back.
seen them go, the Nykaa, Zomato's, PB Fintechs, all of them come down to what, 1/3 of the listing price?
Yeah.
In some
So,
cases.
so now the despair phase has started. Is it done? I don't know. I mean, because what happens in US happens here. So if the US markets have bottomed out, like Zoom has come down from 220 billion to 20 billion. And now nobody wants to talk about Zoom. Actually, their profits and everything are better. So what I would say, I think the ultimate despaired valuation is going to come from, apart from HPBP, IOC, I think digital sector. And where digital companies might be available as better values than value companies. Like 1 time book, 2 times book. Nobody is looking at their book values. Okay, they are making losses. So I think there is an opportunity to study. I'm not saying go and jump, but clearly digital companies are going to become very big. Some of them who are successful, some of them will become like Amazons of India. So you have to now start studying. And at some point of time, you can start buying little, and then the better days will come.
Okay. A final question to get the banks also in. When will you think we will reach euphoria stage in public sector banks? I'll tell you what, about 6 months back, every brokerage had SBI in their buy list. Of course, you had HDFC Bank, all the private sector, the top 4 private sector banks, and you had SBI. Then BOB. And in the last 1 week, BOI has come into the fray. So when will it be euphoria?
You're asking me?
I'm asking, would ask all the 3.
No, they are the more intelligent
Okay,
guys.
all right.
So they know the credit cycle, they
Are
know...
we anywhere close to euphoria with respect to our approach to public sector banks?
Latha, RBI does not allow us to invest in any stock. I don't look at what the stock prices are, including mine, because it's a waste of time. But I don't know about the euphoria. I think the question we have to ask ourselves is, what has really changed in how these public sector banks are being managed? I understand the credit cycle. And are we going to make the same mistakes? Doesn't matter. Earlier we made mistakes in wholesale. Will the system allow us to make mistakes on the retail side now going forward, as you pointed out? And ultimately, what value they can derive in terms of margins and the costs, and what flexibility they have to do something different in the system. As Raamdeo pointed out, they were really undervalued, and I think you have seen some valuation going up. At what point it happens, I don't know. I think it depends on the credit cycle. If the credit cycle continues to last for, let's say, the next 5 to 8 years, I think it could continue. If there is a shock, whatever that shock is, I don't know. Then I think it could. They will be the ones who will get hit the most very quickly, because they will find it difficult to absorb the shock. Because let's also not underestimate the fact that from a capital ratios perspective, they are still low. They're not, they're not as high as you would like to see, or what a lot of other private sector banks have. So they will get a shock, and at that time they will have to really absorb that hit in the balance sheet, and they do not have that much of absorption capacity. So growth, etc., would have to come down. So I'm giving a balanced answer. I don't know, because I'm not a stock picker. I think Raamdeo can do a much better job. But
Mr. Mistry, you want to take a jab at that? Public sector banks, are we reaching?
Without getting into specific public sector or private sector, what I can say is that for the banking sector as a whole, over the last 8 years, there has been a tremendous amount of reforms that have come in. If you look at the banking sector in early 2010, 11, 12, riddled with non-performing loans, undisclosed non-performing loans, low capital, and huge problems. Then came this whole process of cleaning up 2014, 15, 16, 17. And to my mind, and during COVID, a lot of banks have gone and recapitalized themselves. So today, the banking sector as a whole, forget public, private, all of them, stands very, very strong.
Yeah.
Yes.
I would only urge that, yes, I think there is a lot more to go in public sector banks. And so you're going to make tons of money. You'll not believe how much money you made. The issue is, it remains a volatile entity.
Sector.
So when you make a lot of money, leave a lot on the table and run. Don't forget, don't become buy and hold, because they will remain volatile. That's my message.
Okay. Well, I think this has been an extremely enlightening session that we've had. with Amitabh, Mr. Mistry, and Raamdeo. Thank you very much. It's given us some tools to think. But like Amitabh and I don't know about Mistry, but like Amitabh, we are also not allowed to invest in stocks. So we do the easy way. We trust people like Raamdeo. Thank you very much for a very enlightening session. I believe a Q&A is allowed.
Rohini, are we doing Q&A? So if you're okay, we can...
If Mr. Mistry can wait, can we do a Q&A? No, okay. All right, at 6:45 is hard stop.
Okay, great. So thank you very much, sirs, for a very insightful session. And Latha, you, as usual, did a brilliant job of moderating the panel. So that brings us to the end of the program and the presentation of the 27th Wealth Creation Study. Before we wind up, I would love our founder, Mr. Raamdeo Agrawal, to felicitate the panelists. So if we can have the token of appreciations. Great. So, unless I think they want a photo with all of you. Yeah. So, I think we can. Yeah. Great. Thank you very much, everyone. The physical copies of the Wealth Creation Study are kept outside, so you can collect them on your way out. And there's dinner served on the ground floor. Thank you.